A weekly paycheck from a single Bitcoin mining stock wrapper sounds like a money printer until you open the machine and see smoke, gears, and a NAV chart falling down the stairs. Today on Income Autopsy, we're cutting into MAAY, a tiny, turbocharged, options income ETF promising monster, cash flow around one of the wildest stocks on the market. Today we're covering the Granite Shares Yield Boost MAAY ETF, ticker MAAY, from Granite Shares. As of June 30, 2026, this is not a boring dividend fund full of utilities and sleepy banks. MAAY is a derivative income ETF built around MARA Holdings Inc., the Bitcoin mining company. The fund is actively managed, seeks current income, and also seeks the daily 2x leverage of MARA price performance. So the engine is not own a basket of profitable companies and collect dividends. The engine is closer to park collateral, write options, chase income, and tie the ride to a volatile underlying stock with leverage in the mix. That can create big weekly checks, but it can also turn the fund into a cash flow machine that is slowly consuming its own furniture. Before we autopsy the numbers, quick but important disclaimer. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security or ETF. ETFs can lose value, including funds that make frequent or high distributions. Distribution rates can change, fund strategies can change, and option income products can behave very differently from plain stock or bond funds. Always verify the current prospectus, holdings, distribution notices, tax documents, and official fund materials before making any decision. And if this affects your real money, taxes, retirement plan, or risk exposure, consult a qualified financial, tax, or legal professional who understands your situation. Here is the quick body scan. MAAY launched on November 4, 2025. It pays weekly, charges a 1% expense ratio, and has only $3 million in assets under management. That matters because this is not a huge, seasoned income ETF with years of trading history and deep assets behind it. It is small, young, and attached to a very high volatility theme. The latest net asset value and price are $6.63. The asset class is equity, but the category is derivative income, which tells you the real story. The payout is manufactured through derivatives rather than simply harvested from company dividends. Think of this as a specialized income contraption, not a broad market holding. The label says ETF, but the behavior is closer to a leveraged options income lab experiment. Now the billboard number. The headline distribution yield is 148%. That is the number that grabs eyeballs, stops thumbs, and makes normal dividend stocks look like they showed up with lunch money. But with a fund like this, yield is not the same thing as profit. It is a distribution rate based on cash being paid out relative to the current fund price. The mechanical annualized rate from the latest payment is 93%, which is still enormous, but it already shows how sensitive these numbers are to the payment you choose. The latest distribution was 12 cents per share. A weekly payout can feel comforting because the cash arrives often, but frequency does not make the economics safer. The real question is not, how big is the yield? It is, what did the fund have to sacrifice to produce it? The distribution trend is where the shine starts to dull. The first 4 average payout was 59 cents, while the latest 4 average was 12 cents. That is not a subtle drift. That is the launch period fire hose calming down into a much smaller stream. For income investors, this matters because the early payments can set an expectation that the fund may not maintain as market conditions, option premiums, fund price, and strategy behavior evolve. A big first impression can make the fund look like a permanent cash machine, but the payment history says the weekly checks have already stepped down from the initial period. That does not automatically mean the fund is broken. It does mean you should not annualize the honeymoon and call it normal life. In high-yield ETFs, the trend often tells you more than the headline. Now we look at the part of the autopsy table nobody wants to look at: NAV decay. MAAY's launch reference price was $24.52, and the latest price is $6.63. The NAV return since inception is negative 73%, and the max drawdown is also negative 73%. That means the fund's underlying value has taken a brutal hit over its short life. This is crucial because a high payout can distract from the shrinking base underneath it. If the fund pays you cash while the share price collapses, your brokerage screen may show income activity, but your total capital pile may still be getting smaller. With option income funds, the NAV path is the lie detector. It asks a simple question. After the distributions, after the volatility, after the strategy did its thing, is the asset base holding up? Cash distributions since launch were $9.81 per share. That sounds huge compared with the current share price, and it is exactly why funds like this attract attention. But the simple distribution-inclusive return since inception is negative 33%. That number is the cold shower. It means the cash paid out did not fully offset the fall in the fund's value over the period measured. This is why income autopsy separates income received from wealth retained. A fund can throw off a lot of cash and still leave the investor behind if the principal erodes faster than the checks arrive. For some traders, that cash flow profile may still have a purpose. For everyday investors looking for durable income, it raises a sharper question. Are you harvesting income, or are you being handed pieces of your own account back with a bow on top? Here is the machine under the hood. The listed holdings are US dollars at 68%, United States Treasury bills at 34%, plus 6 put options the fund writes for premium income. So this is not simply a fund owning a pile of operating businesses. It is mostly collateral, with the income engine coming from options tied to the MAAY theme. When a fund writes options, it collects premium upfront. That premium can help fund distributions, especially when the underlying asset is volatile, because volatile names tend to have richer option pricing. But there is no free buffet. Writing options can create obligations, limit how much upside the fund captures, and expose the fund to ugly losses when the underlying moves against the trade. Add the goal of daily 2 times leveraged price performance, and the ride becomes even more sensitive. If you are watching MAAY from here, do not start with the yield. Start with the checklist. First, watch whether weekly distributions stabilize or keep sliding from the launch period levels. Second, watch NAV, because that is the fund's fuel gauge. If it keeps bleeding, the cash flow may be coming at the expense of the machine itself. Third, check official fund documents for distribution character, especially whether payments include return of capital. Fourth, remember the fund is small, so liquidity, spreads, and product survival deserve attention. Fifth, compare the fund's results against simply owning the underlying exposure, because an income wrapper should be judged by what it adds after costs, volatility, and lost upside. And finally, ask whether you actually want leveraged single-name-linked income risk, or whether the giant payout is pulling your eyes away from the risk label. My clean read, MAAY, is not a traditional income investment wearing a slightly flashy jacket. It is a high-octane options income product wrapped around a volatile Bitcoin mining stock theme, with leverage in the recipe and weekly cash payments as the headline attraction. The distributions are real, but the damage to NAV has also been real. That combination makes this a fund for very careful research, not casual yield chasing. The right question is not, can this pay me a lot? It clearly can pay a lot at times. The better question is, after the payouts, volatility, erosion, and opportunity cost, am I actually better off? For MAAY, the autopsy shows a loud income story, a fragile capital story, and a trade-off that investors need to understand before the yield number does all the talking. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button. It genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.